Alright everyone, Cowboy Trades here, welcome back to the channel. So I just wanted to make a quick update on one chart, being the yield curve, which is currently predicting another recession for the US economy. In fact, this is predicting the worst recession that we've seen in the past 34 years, since all the way back in 1990. So let's talk about this. Well, first of all, what is the yield curve? Well, the yield curve is simply what you get when you look at the US 10-year government bonds and you subtract the valuation of the 10-year bonds with the US 2-year bonds. Now, why would you do this? Well, basically, if we come over to the SP 500 and we look at these government bonds, you can see that these are inversely correlated to your equity market. So at this moment in time, looking at 2-year government bonds, they're coming in at a rate of 4.7%. And this means that if you are looking at putting some capital in government bonds, which is a risk-free investment, you'll be looking at getting around about 4.7% return, and you can lock that in for a 2-year rate if you're looking at the 2-year government bonds. Now, why is this important? Well, basically, if we come back over to the yield curve, what happens when the 2-year heavily starts outweighing the 10-year is you get these protracted inversions on the yield curve. And historically, these protracted inversions of the yield curve have historically predicted recessions in the United States. So basically, an inverted yield curve reflects investor sentiment, and it tells us that the bond market is predicting not only a recession, but it's predicting for government bonds to heavily outperform the S&P 500, and this would mean that your equity markets and cryptocurrency markets are going to crash. Now, what's super interesting if we do look at the yield curve, also before we do jump into this, if you do want to learn more about how the US 10-2, also known as the yield curve, is calculated, and you want slightly more knowledge on everything about the yield curve, then be sure to come over to my YouTube channel, head over to the playlist, and find this video called Understanding Market Conditions, where we detail everything you need to know about the yield curve. But we've covered the basics of this. Now let's get into the analysis. So like we said, these protracted inversions on the yield curve have historically always called for recession. So for example, these are the three main ones that I want you to focus on. Obviously, the 2000 dot-com crash, everyone knows about that. Your 2008 subprime financial crisis. And you might be looking at this and thinking, why is this between 2006 and 2007? We'll get to that in just one second. And also in 2022 to 2023, whatever is going on in this situation, once again, there's not really one clear-cut name you can associate with this recession that we're going to be seeing in the immediate short term. So I'll just leave this for you to describe how you want it. Now, if we do go back to the first data point over here, this wasn't a major recession. In fact, the equity markets only broke down about 20% on the onset of the Gulf War. But what this really was is this was a recession in real GDP, a recession in GDP, and also the unemployment rate for the US absolutely skyrocketed up 43% from the onset of the Gulf War, which was round about July 1990. You can see this rose from an unemployment rate of 5.45% all the way up to just over / around 7.8%. So this first recession that we saw was very short-lived. It lasted about 8 months, and this was more of a recession in terms of, like we just said, the unemployment rate, GDP, and etc. So what I really want to focus on from here is these following data points. As we all know, the dot-com crash, the 2008 subprime financial crisis, and whatever's happening right now in 2022/2023. So if we look at this, like we just discussed, these inversions of the yield curve have historically predicted recessions prior to the recessions happening. So you can see over here, basically I've got this red box highlighted, and every single time we've come down into this red box, we've had a recession. And there's been times where we've been very close, like over here, 2019, we got very close but didn't come into this box. Over here in the year of 98, this was, another recession that really affected the Asian markets the most. I won't discuss these too much because we really want to focus on these 3 data points. But when we are looking at the 2000 financial crisis, what you can see is the yield curve broke down predicting a recession on the 3rd of January in the year 2000. Now, if we look at what happened over in this chart, you can literally see the 3rd of January was pretty much, in fact, it was literally the exact top for the S&P 500. So what happened is the the bond market being, the yield curve, obviously When we're looking at the yield curve, once again, we're looking at the summation of the US 10-year bonds minus the 2-year bonds. This reflects investor sentiment in the bond market, and they've always historically been good at predicting these recessions prior to them happening. So once again, over in the year 2000, you can see when the bond market was getting terrified, when the yield curve was predicting a recession, this was the top of the tech stock bubble in the year 2000. Bond markets were saying, hey, we're going to have a recession. We're way too overextended. And what happened over the next 2 years, 2.5 years, really, the equity markets, all of your markets absolutely had a horrible nuke to the downside. And we saw one of the worst financial crises of all time. And then we come back over to the yield curve, and you can see what happened is in 2006, the 2nd of January, we broke down into this red box again, and then we spent a decent amount of time in this area towards the latter half of 2006. And also in the beginning of 2007. But bear in mind, we are looking at the 3-month time frame. So you can see these two data candles alone comprise about 6 months worth of data traded right around this inversion area in the yield curve, historically telling us that we should be going into recession. And obviously, as you can see, right round about here was where we started to come out of this area for the bond market. So your yield curve was predicting a recession to take place relatively soon after this data point. And once again, as you can see, just like this data point over here, once we spent a significant amount of time, or a few months or so over here, this was almost a year or so, you can see that this predicted the top of the 2000 financial crisis, and this more or less predicted the top before the subprime mortgage crisis really started booting the markets down to the downside. I don't want to spend too long explaining, what happened in the dot-com crash. Obviously, tech stocks basically just absolutely imploded to the downside. And also, if you're looking at the subprime mortgage crisis, if you don't know what happened over here, I recommend going to watch The Big Short. Basically, all you need to know is there were a bunch of bad mortgages that got defaulted on, and this caused a massive recession in not only the US, but the markets in general across the entire globe. This was the global financial crisis. So once again, we're seeing the yield curve predict this with this inversion of the yield curve before the actual market capitulated. Now, what is super interesting is, according to the yield curve, the worst recessions that we saw were in terms of the unemployment rate back in, 1990 due to the Gulf War, and also the dot-com financial crisis. These two financial crises were arguably, two of the most important ones we've ever seen. Once again, 2008 was also, of course, very important. But looking at the yield curve, you can see the bond market was saying these two are going to be very bad. And of course, unemployment was terrible back in 1990. And also, the dot-com crisis was extremely painful for the markets. One of the worst ones we've ever seen, if not arguably one of the worst crashes that we've ever had. And if we do look at how low the yield curve came down on both of these events, you can see that we came down to an inversion of minus 0.47%, meaning that the US 2-year government bonds were heavily outweighing the 10-year government bonds, because obviously the yield curve is just the summation of the 10 minus the 2. The 10-year government bonds are currently sitting around about 4%, and the 2-year government bonds are sitting around about 4.7%. So if we're taking 4.7 away from 3.95, this is the data point that we have down here on the 10 minus 2, which is currently clocking in at, let me get rid of this, 0.774%, minus 0.774%, should I say. So if we are coming over to the weekly time frame, what you can see is this red box marked the lows when the yield curve was saying we're going to have a nasty recession, in 2008 or 2006, 2007. This chart was predicting a nasty recession as well. And once again, in the year of 2022, we broke down into this box, and in 2023 or late 2022, we broke beneath this level. And really, in the past couple of days or so, we detailed this on the channel, how on February the 14th, we broke down further. February the 15th, we broke down further. We've had a tiny bit of a bounce in the past few days, but of course, a tiny bounce isn't going to help us at this moment in time. We're currently sitting in the worst place. The bond market is currently starting to price in the worst recession that the US has seen in the past 34 years. And historically, looking at how this has predicted trends in the equity markets, it is not looking good whatsoever. So like I said, just wanted to get this one video out focusing on the yield curve currently predicting another horrible, nasty recession in the US economy. This is obviously going to be extremely bad for your equity markets, being, you know, your SP 500, which is mainly what we focus on the channel. And also, if we do come over to Bitcoin as well, you can see, you know, since the yield curve started to break down to the downside, really it started topping out round about here, which you can see was the first top in Bitcoin. And, you know, for example, over here, you can see this is where the yield curve really started to nuke to the downside. And that was actually the exact top for your equity markets, being your S&P 500. So as you can see, the yield curve, this is a leading indicator. Your equity markets, being your S&P 500, and your cryptocurrency markets, mainly being your Bitcoin, is mainly going to follow what is happening in the yield curves. So there we go. The bond markets are starting to trade based on the fact that they believe we're going to have the worst recession we've seen in the past 34 years. The yield curve, because of how the bond markets are trading right now, because of the way that your US government bonds are shooting to the upside right now, the yield curve, because of this, has broken to the downside to the lowest levels that we've seen recorded on this chart, even recorded on the equity market. So not looking good whatsoever right now. Stay safe out there. That's all I've got for you for this video, my friends. As always, if you do enjoy this content, let me know down below by leaving a like and a comment. Share the videos with your friends. Also, if you want to learn more about the yield curve, feel free to come over and check out my educational playlist. There's 33 videos in there, and this one video, Understanding Market Conditions, will run through a little bit more in depth, some more precursors of how the yield curve is calculated, more about it, more reasons why you should use it other than the ones I described in this video. And also, if you do want more of my content, feel free to come over to my Twitter at 618_cowboy, and also make sure you come and join the Discord. Head over to my YouTube, click on the About. You can see all of my official links from Twitter, Discord, Instagram, and my merch store are down below. But for this video, my friends, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.